Hello, and this is Global Business Insights, where we look deeper at the headlines from a business perspective. It's now a different race and unexpected turn as President Joe Biden said he would not stand for re-election, also endorsing Vice President Kamala Harris for the presidential nominee role. This implies some market volatility and uncertainty and possibly an impact on the crypto and clean energy trade as analysts digest the news. Most believe the policies will not change as we observe the process towards the Democratic Convention and watch for how this affects odds of a Trump presidency. It may depend on whether the process leads to more turmoil or is smooth, as the DNC promises a transparent, orderly process. A lot can still change in this space, but so far endorsements and donations are piling in for the Kamala ticket. All eyes on the VP nominee that will, of course, soon be announced. China's central bank unexpectedly cut rates in an effort to support the economy. The People's Bank of China announced today that it cut the one-year loan prime rate by 10 basis points from 3.45% to 3.35% and cut the 5-year loan prime rate from 3.95% to 3.85%. Billionaire Aliko Dangote has responded to deny that he called for suspension of diesel and aviation fuel imports, also debunking claims that the quality of diesel from his refinery in terms of sulfur content did not meet standards, Organization of Nigeria standards. Analysts are calling for an independent verification on quality claims and implications, even as many urge for support for success of the refinery, which has a huge impact on the Nigerian economy. Business analyst Lekan Sote shares his views on the situation. And in Nigeria, the Central Bank of Nigeria 286th Monetary Policy Committee meeting begins today. It goes on till tomorrow. The committee will be concerned at still rising inflation at 35.19% in June and the real sector groaning under record high interest rates at 26.25%. The rate decisions will be tomorrow. A credit ratings company is being established to meet the unique needs of Africa's sovereign borrowers. The company is set to be ready to go active by next year, according to an African Union official. Albert Muchanga, AU Commissioner for Development, Trade, Tourism, Industry and Minerals, said the institution won't be owned by the regional bloc and will be independent and professional. Although CrowdStrike says the worst is over in the massive IT failure that affected over 8 million devices, grounded flights, and disrupted corporations around the world last week, many are still yet to have completely recovered to normal operations. Businesses were said to be vulnerable to hackers and malware and need caution in engaging the right support to get their systems back running. Others are calling for regulation to protect from situations in future where companies are vulnerable to the concentration of very few dominant operators. And in the UK, Britain's new Finance Minister, Rachel Reeves, is considering inflation-busting pay increases for almost 2 million government employees later this month to avoid crippling public sector strikes. Peer review bodies have recommended a 5.5% wage rise for 460,000 teachers and 1.4 million staff in the state-run National Health Service. Polls are now being reset and may provide fresh surprises. The Kamala nomination is not obvious and the possible turmoil may still play to increase the likelihood of a win by former President Donald Trump in November. It's too early to say how this shapes out. Analysts see a muted stock reaction as this was largely expected after the debate debacle earlier this month. There may, however, be small unwinding of the so-called Trump trade, that is buying crypto, fossil fuel trade, given that some see Vice President Harris with a slightly better chance of winning than Biden. Former President Barack Obama has, however, called for a transparent process as Kamala gets busy converting Biden's delegates, who may not all be in agreement with the endorsement. And meanwhile, US futures were only slightly higher this morning as we saw dollar slide and treasuries up, and risk aversion could be hitting stocks harder than the previous week as investors digest the unfamiliar political context. We also get the beginning of quarter two big tech earnings reporting. Tesla and Alphabet will be first of the Magnificent Seven to report earnings tomorrow. On Thursday, we get US Q2 economic growth data and the June reading of personal consumption expenditures index. That's the Fed's preferred inflation metric, comes out on Friday. Economists expect that core PCE will be increased 2.5% in June from the previous year, down from May's 2.6% annual gain. Over the prior months, economists expect core PCE rising 0.2%, slightly above May's 0.1% increase. And this comes less than a week before the Fed's next monetary policy decision on July 31, where there is no expectation of rate changes, but traders see a 93% likelihood of the Fed cutting interest rates in September, leading to selling off the big tech winners in favor of more rate-sensitive cyclical stocks such as small caps and industrials benefiting from lower rates. African finance ministers first considered setting up a new ratings agency in 2021 amid complaints of unfair treatment by the well-known international credit rating firms that they said lead to higher interest rates relative to what other emerging market borrowers and developed countries pay. We gather the task is being undertaken now by the African Peer Review Mechanism, African Development Bank, African Export-Import Bank, and the AU Commission, and is getting closer to operationalization. This is a huge plus if its focus on Africa implies more comprehensive and accurate scrutiny on the well-known risk factors and which courageously elevates the issues. It will be better accepted by African governments and addresses the old excuse that traditional agencies are biased. A better understanding of Africa will also help investors who are seeking viable investment outlets to move with more confidence. This should not be a shortcut to get lower interest rates or to understate risks, and can lose credibility quickly if perceived as inadequate in the required depth. Many, and rightly so, have complained of the broad brush approach to Africa that has blocked fair access to investments and raised costs of borrowing needlessly due to often inaccurate assessments on risks. This is certainly going to help move the Africa Renaissance forward at a time of recalibration of investment dials and new interest in Africa. Aliko Dangote has spoken to the press, conveying frustrations with the regulators and the negative headlines on its push to ban diesel imports. Meanwhile, analysts are calling for independent inspectors certification by agencies nominated by the Nigerian Midstream and Downstream Regulatory Agency to review the product quality situation. It is possible that this may also be a case in which the refinery desulfurization equipment or process has settled into better sulfur data reads, noting that the regulators said the refinery is still in a pre-commissioning stage and not ready for a license to operate. Putting pressure on regulators or inspectors is also not the way forward. Senior Business Analyst Lekan Sote comments on the situation.
The government of former President Muhammadu Buhari informed Nigerians that it had acquired 20% of Dangote Refinery for the sum of $2.7 billion. Rumors say that payment for the shares was going to be made through a mix of cash as well as pledges of crude petroleum. Now, sometime not too long ago, President Aliko Dangote of Dangote Industries Limited announced that the shares of NNPCL has been downgraded to 7.2%. Some argue or allege or suggest that, well, maybe because government is not supplying the crude it has pledged for the shares. You will notice that news report indicated that Dangote refinery imports crude oil from outside the country. And reasons for this could be, one, the fact that NNPC is unable to meet up with the quota allocated to it by OPEC because of obvious reasons of oil bunkering. And then also, both the Buhari government as well as the new government of President Tinubu have pledged crude oil for debts, like a debt crude oil swap. And then, of course, the joint venture partners, that is the international oil companies, the joint venture partners of NNPC in the mining of Nigeria's crude petroleum, will certainly insist on having their own quota so that they can supply to their own customers, not to default. Now, surprisingly, Ahmed Farouk, CEO of Nigerian or the National Midstream and Downstream Regulatory Agency, suddenly came out of the blue to announce that Dangote's diesel is of a lower quality than the one imported. But everybody knows that NNPC is the one that is importing petroleum products into this country. News reports indicate that a team of the members of the House of Representatives of Nigeria National Assembly visited Dangote refinery not too long ago, and Aliko Dangote was able to prove to them that indeed his own diesel was 80% or is 80% better than the imported one. Experts need to confirm this. But what is surprising, what is baffling, is that rather than thinking of a way to run the 4 petroleum refineries owned by NNPC so that they can actually effectively compete with Dangote, who they seem to be accusing of monopoly, Mr. Farouk is busy demarketing the one that is produced locally. It's a shame, really. And it's funny that Aliko Dangote, rather than mind his business, seems to be losing focus. He wants to drop the ball by saying that he will no longer participate in the steel mining business.
The NMDPRA needs to clarify the position, which may just mean commissioning fresh tests and certifications. It was a relief that Dangote denied asking for ban on diesel imports, and there could be an investigation on dumping of diesel and the possible need for higher import tariffs to protect local producers like Dangote. What everyone agrees is that being a pioneer strategic operation, Dangote Refineries is entitled to some protections, but these have to be transparent and shouldn't hurt competitiveness and energy security. Asia Pacific markets mostly fell on the news that US President Joe Biden had dropped out on the presidential race. If you look at where they stand, 1.16%, that was Nikkei 225 down. Hang Seng was up 1.22%. Shanghai Composite and the Shenzhen Composite were also in negative territory. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please send your comments. Again, thank you so very much for watching.